Welcome to This Explainer. Okay, so if you've glanced at the news lately, you've probably seen the headlines flashing red about the Indian currency. Let's dive right into this historic drop of the rupee and unpack exactly what it means for your money, your budget, and your future plans. We're going to cut through all the complex jargon today and just focus entirely on the facts. 95.21. That's where the Indian rupee hit an absolute all-time low against the US dollar back in late March 2026. Now, that isn't just some random number bouncing around on a trader's screen. That represents massive macroeconomic shifts coming straight for your personal finances. Whether you're filling up your gas tank, planning a trip abroad, or honestly just buying groceries, this specific digit completely alters the math of your everyday life.
Section 1. The rupee's record drop. Let's look at the timeline to really understand the sheer scale of the economic scenario we're dealing with here.
We are looking at a steep 11% decline in the rupee's value since the start of the 2026 financial year. To put that into perspective for you, this is literally the worst drop we've seen in about 14 years. It's a huge shift, and you might be wondering, what's driving this? Well, it's basically a perfect storm. You've got elevated crude oil prices linked to conflicts in West Asia, a generally super strong US dollar globally, and a widening current account deficit as India's energy import bills just keep climbing. It's a ton of global market pressure pushing down on the currency.
But fighting back against that pressure comes at a massive cost. India's foreign exchange reserves fell from an all-time peak of $728.5 billion in late February down to around $682.3 billion by late May. That drop represents the central bank actively stepping in, selling off dollars to defend the rupee from going into a complete freefall amid all these geopolitical tensions. They spent billions just to cushion the blow.
Section 2. Why currencies move. To truly grasp why these numbers look the way they do, we need to step back for a second. I mean, why can't a government just snap its fingers and fix a currency's value, right? It all comes down to a core economic principle known as the impossible trinity. It sounds a bit like a movie title, but this is a textbook-grade lesson happening right in front of us. The impossible trinity basically dictates that a country cannot have all three of these things at once: a stable exchange rate, completely free capital flows in and out of the country, and an independent monetary policy setting interest rates. You can only ever pick two. Right now, policymakers are forced into some really tough trade-offs. If they want to control inflation at home while keeping capital moving, they just have to let the exchange rate absorb the shock. Section 3. Inside the RBI response. So, the crucial point is, how is the Reserve Bank of India actually responding to this immense pressure? Let's take a look under the hood.
The RBI's battle plan escalated pretty rapidly. Back in late March, it started with those heavy dollar sales we talked about to defend the rupee. By mid-May, things were serious enough that the Prime Minister made public appeals for citizens to conserve foreign exchange, literally urging people to cut down on foreign travel and reduce gold purchases. And then, by early July, the RBI instituted a strict $100 million cap on banks' speculative currency trading. They essentially told local trading desks to pump the brakes on massive bets that were making the currency even more volatile.
But, playing defense isn't enough. They need to play offense too, by bringing more dollars into the country. So, to actively encourage dollar inflows, the RBI announced they're bearing the hedging costs on certain non-resident Indian bank deposits, specifically FCNR deposits, all the way until September 2026. This is a direct, tangible incentive for NRIs to park their foreign currency in Indian banks, which really helps to shore up domestic liquidity. And what RBI Governor Sanjay Malhotra recently clarified brilliantly captures the central bank's true goal here. He noted that their intervention is all about smoothing out volatility, not defending some fixed artificial level. They aren't trying to magically reverse the market. They are just trying to ensure the market doesn't completely panic. At the end of the day, the exchange rate remains fundamentally market-determined.
Section 4. Impact on your wallet. All right, let's step away from the central bank, the billions of dollars, and the impossible trinity. Let's talk about how this directly impacts you. Because here's the thing. A weak currency isn't entirely bad news. It really just depends on what side of the equation you sit on. For consumers, the pain is very real. A weaker rupee makes imported oil costlier, which drives up pump prices. U.S. college tuition, foreign trips, basic imported goods, they all suddenly cost more. But conversely, this actually provides a major boost in revenue for IT service exporters who earn in dollars. And for NRIs sending money home, their dollars now buy significantly more rupees. So nuance really matters here.
However, the overarching, unavoidable threat for absolutely everyone is inflation. We are facing a dangerous double layer of risk right now. You've got costlier imported oil feeding directly into transport costs, and that's combined with a really weak monsoon forecast. In fact, we literally just saw the driest June in over a decade, which threatens rural demand and spikes food prices. So you have imported inflation meeting domestic food inflation head-on.
Section 5. Navigating the currency shift. Okay, let's dive into how you should practically navigate these shifts. What can you actually do with all this information today?
The key takeaways here are all about actionable awareness. First, you'll want to immediately adjust any upcoming travel or education budgets to account for a weaker rupee. Second, definitely understand how import costs might affect EMIs on vehicles or electronics you're planning to buy. Remember our lesson on the RBI. Expect volatility to continue because they are only smoothing the drops, they aren't preventing them entirely. Above all, completely avoid making panic decisions. Please don't rush to convert your life savings to dollars just because of a scary headline. Always consult a certified financial advisor before shifting your investment portfolio around.
As we wrap up this explainer, I want you to consider a critical question. As the rupee finds its new baseline, how will these massive macroeconomic forces, the impossible trinity, global oil markets, and central bank defense strategies, reshape your own purchasing power in the coming months? The economy is a massive, interconnected machine, and we are all a part of it. Thank you so much for joining me today. And be sure to subscribe for our next follow-up explainer so you can stay informed, stay prepared, and keep learning. Catch you next time.